how do you approach a mortgage versus investment decision differently for a business owner who have both personal and corporate money to consider?
Yeah, so that's a great question. And we come across it often. There's so many self-employed business owners in Canada. So it's so common. And the nice thing is, speaking from sort of the mortgage side of this conversation, there are a lot of options if you are a business owner in the way that lenders look at your overall financials. And I'm not just talking about your personal tax returns. I'm also talking about your corporate financial statements, any money you have invested in the name of the corporation. So there's a lot of options and there's a lot of ways to look at it. I find most business owners want to draw down as little income as possible from their corporation. And of course, that minimizes tax exposure. So I would say, obviously that's a conversation to engage your accountant in as well to see, if you were to pull out some money from the corporation, what's the tax bill on that? And then effectively, how would that play out on the mortgage side? How much would it really save you? If it's not going to save you more than what you're going to pay in tax, well then, I don't know that it makes sense. And so you may want to keep that money isolated in the corporation. Now, if you're sole proprietor, it's a little bit different. Again, the lens is a little bit different in terms of how you qualify for a mortgage, but there are still tons of options. Cash flow for business owners is also super important. So that's something we want to sort of project out. It's one thing to say you're approved for a mortgage, here's your monthly payment. What does the individual sort of anticipate on the business side of things in the future? And how do we make sure that the payment that they're going to be sort of, say, locked into for 3, 4, 5 years, make sure that's still manageable in the years ahead, right? So that is something that, engage your accountant with. And I think for the most part, most business owners want to keep that money in the corporation. They incorporate it for a reason. And so that's where you come in and you'd be able to invest that money appropriately and
yeah, I think in this case, hit on the head exactly, or the nail on the head exactly where you need to be here, because bringing your accountant in on this discussion makes the most sense. This typically would need, when you're dealing with an incorporated business owner, you definitely need an accountant, because a lot of the business owners I work with say, keep it in the corporation because I'm not really paying much tax on it. Mm-hmm. The downside there is that you're actually reducing the amount of RSP and CPP room that you have, or not maximizing. Even if you pay tax, on the way out, you get a benefit from putting it into your RSP. So typically we see that being even, if not, an advantage to taking it out. But it also kind of makes sense when you have the math in front of you. So for example, just answering the last question, how much is your mortgage? How much tax are you paying? What's your expected rate of return? These things typically might involve, somebody like yourself, somebody like myself, and an accountant. So it's pretty complex, but really it's just sort of, yeah, it's definitely collaborative. It's definitely, a lot of addition and subtraction, but, it also could be psychological. I've had a number of people say, I really don't want mortgage debt, at all.
Yeah, true. Yeah.
So if that's what you want, we'll show you the math, but could really just say, like, what's the math and keeping it in your corporation? What's the math taking it out?
Yeah, for sure.